Alrighty. So in today's video, we are going to continue our beginner series for the option strategies. So if you are new to trading options, you have been trading for under a year, or maybe you have a small trading account size, right? Maybe under $50,000, then you can go to my channel and look for all the different videos which I have, which is specifically catered for you if you're just starting out, right? So for today's video, we are going to be talking about the best passive income option strategies for beginners, right? So we are going to use option strategies to try and create a passive income for you. All right. So first of all, let us define what is passive income. All right. So if you were to go to Google and you were to search the definition of passive income, right? So this is one of them that has showed up, and this is by Britannica.com. So it says that passive income is money that you earn either automatically or without putting in much effort, right? So they give a few examples. So you have rental income. So basically, you have to find the property first, then you have to do up the place, and then you have to find the tenant, all right? Do all this work once. And then once you've got the tenant, then that's where you're going to get, your rental income. And then dividends income as well. So maybe you have to find these dividend stocks, those fundamentally good dividend stocks. And then once you've done the work once, invest in it, and then the dividends will just keep paying out to you, right? Same as interest income as well. So maybe you buy into some bonds, government bonds, or those kind of fixed income securities. Well, basically you just put it inside there, and then they will just pay you an income, right? Depending on how often it is, right? So this is basically the definition of passive income. So when it comes to options, we also want to build that sort of passive income as well. So when it comes to options, we want to find a strategy where we only have to do the work once and then receive an income for it. So what this means is that we want a strategy where there is a high probability of profit, and we do not want any management of the trade where we can hold to expiration, because most of the strategies we do want to manage at some time or another, right? Where maybe because the delta has gone, a little bit too high, we want to change the trade a little bit. Maybe we want to, adjust the theta. We want to roll it. So most of the time there is some sort of management. But for this strategy, we want to try and build this strategy where there's no management involved, right? Also, that also means that there must be no risk of assignment on shares, right? Because if you're going to get assigned on the shares, then it's not going to be that passive, right? Because you need to worry about how to unwind those shares, right? If you're going to be long shares, you're going to be short shares, that's going to be quite a problem for your account, especially if you don't have the funds, the margin to hold on to those shares. And more importantly, we need to have a statistical edge over time. So this is the basis of how we want to create this passive income, right, through options. So what is this strategy that can help us generate a passive income through options? Then this strategy is none other than the put broken wing butterfly, right? So this is on the cash settled index options. Very important. We only want to do this on cash settled index options, and I'll get into the reasons why. So basically it's the put broken wing butterfly, or in short, the put BWB, right? The put BWB. That sounds weird. I think it's the put BWB. That sounds better. So we call it the put BWB. All right. So what is this put BWB? The put broken wing butterfly. So the put broken wing butterfly is basically a combination of two different types of spread, right? First, you have the put credit spread, and then you have the put debit spread. So the whole idea down here is to use the credit spread, which is on the left hand side down here. So you can see down here, this is where the put credit spread is, where you receive a credit when you put on this spread. And then on the right hand side, I'm just going to draw it like that. This is where the debit spread is. So the whole idea here is to use the credit spread to sort of finance the debit spread over here. So this way, there is no risk to the upside. So the way we are going to construct this put broken wing butterfly is that there is going to be zero risk to the upside and even some small profits, right? So this way, if the markets, really shoots to the moon, well, at least we are still going to get some sort of profit. So there's only risk to one side, which is on the downside, okay? So you can also see this, if you think about it, it is the defined risk version of the put ratio spread. Now, I've talked about the put ratio spread quite a bit on my channel, and as you know, it's one of my favorite strategies that I put on. So the put ratio spread is the undefined risk version. So with the put broken wing butterfly, what you're essentially doing is putting on the put ratio spread down here, and then you're buying this put option down here. You're buying a further out of the money put option so as to define your max risk. So this way, it is much more suitable if you're just starting out, because this way, you do not have to be worried about this unlimited risk or the fact that, the market will go all the way to zero. You get to lose all your money, right? So in a sense, there is some kind of an insurance because of this long put option down here. For those of you who prefer the visual learning, right, then you can see how it looks like on the chart. So this is on the XSP, which is the mini SPX index options. So as you can see down here, this is where we are going to have our 2 short options. And then down here, we have the long put and then another further out of the money long put option, right? So if you just take a look at this, if you're new to all this, it can get a little bit confusing. I understand, definitely, especially if you're just coming on from, you just put on a simple spread, like maybe a credit spread or something like that, right? So for this, you can see down here, there are 2 put options at the same strike, right? That is what makes it a butterfly, right? So the butterfly option strategy, basically you have 2 short options at the same strike. And then for the broken wing butterfly, basically it's a very uneven style of butterfly, right? Because most of the time, the normal butterfly is a very even one. So if I were to draw the P&L graph for the normal butterfly, right, you will see that it actually looks something like this, right? So this is the zero P&L line. So basically you'll see that this is pretty equidistant from here to here most of the time, right? But for this, you notice that we have skewed it a little bit, so that as you can see from the previous P&L graph here, let me just remove all these drawings again. So you can see that we have skewed it so that on the right hand side, this debit spread down here is actually, the width is much smaller compared to this credit spread on the left hand side. All right, so when you skew it this way, you are able to actually remove any risk to the upside from here. Okay, so this is how it looks like on the chart. So based on the chart, you might be wondering, so where is the profit zone? All right, so I have done this for you. You can just see down here, anywhere in the green zone, this is where you get profits, right? The biggest profit is from this point down here all the way to here, because this is where you get your tent, right? So if we go to the P&L graph here, this is the tent over here, right? So anything above this tent, you're going to just get the minimal profits, which is basically the credit which you sold for. So this is for the minimum profit. So as long, if it's above this long put option down here, the market can shoot all the way to the sky. You will still get the minimum profit, which you sold this whole put broken wing butterfly for. Now, on the other hand, because you have already kept your max risk, the most that you can lose is only up to this point down here, right? Depending on where you buy your long put strike. So if the market was to crash all the way down, let's say it even goes to $0, guess what? You're not going to lose everything, because you only can lose what you have a risk for the trade. So in this case, it's up to this point where you have bought this long put spread. So again, this is why it's very good for beginners, especially you're just starting out, because you already know upfront what is the max risk going to be, and it's going to really help you in your capital allocation as well as your psychology. Okay, now the other thing about the put broken wing butterfly is that it is very versatile, right, and can be constructed according to your market view and objectives, right? So there's no one right way to construct this put broken wing butterfly. All right, so let's say, for example, you might want more credit up front. So this is one way that you can adjust it. You notice that the credit down here, you can see, although it's very minimal, you can't really see much of a difference here. But if you would compare it to the one previously, you will notice that this one is much lower, but then you get a much higher tent, so to speak, right? So down here, you can see the tent here is much higher, but for this, the tent is much lower, but you get a higher minimum profits on the right hand side. So basically what your outlook for this is that you might be slightly more bullish, and you think that the market has a better chance for it to go up than to go down. So that is why you don't need that much big of a protection in terms of this tent, right? Basically, if you want more protection to the downside, you're worried that the market is really going to crash, then you want to build one whereby this tent is bigger. But the trade-off is that you forego the upfront credit, right? So if the market goes up, you receive lesser for this spread compared to if you were to construct it this way. On the other hand, if the market really goes down, then guess what? This is going to be better, because you notice your break even is actually further away. Your break even is 431.54. That is why, you know, your win rate is slightly higher. Whereas for this, your win rate is only 87.43, and you can see the break even price is slightly higher. Okay, so again, this comes down to your outlook of the market. Now, on the other hand, you can actually shift your short strikes further up, right? So some people have asked before, you know, what is the delta that you use? So this again really comes down to your outlook of the market. Now, generally, what I like to do is somewhere around the 20 delta. But again, it is really up to your outlook. If you're much more bullish, you can always shift this in, right? Basically closer to the market. So you're getting a higher delta, right? Anything above 20, maybe 25, 30, 35, up to you. And what you'll notice is that as you shift this closer to where the current market price is, basically the market price is somewhere above here. You can't see down here. Right, the market price is somewhere over there, right? So you can see there is some room for the market to actually go down to actually make the profits, right? You can see down here. So if you are slightly, you know, more bullish, you don't think the market is going to go all the way down here, this is where you can shift your short strikes further up, right? So of course, if you shift the short strikes up, your 2 put strikes up, you will notice that your win rate is going to drop as well. So for this put broken wing butterfly, how you want to really profit is in this tense zone down here, right? And if you think about it, let me just remove this. It does look a little bit like a home, don't you think, right? Like a house, right? So imagine this is a very triangular shaped house. You have your windows down here, and then you have a door down here, which looks like some kind of a monster with eyes and mouth, right? But basically, you want the market to actually come in somewhere down here, right? So you have a house down here. This is where you have the biggest profit, the chance of the biggest profit. And also, this is one of the reasons why we want to hold to expiration, because this is a very slow spread. A very slow spread just means that you can see that this purple line down here, right? You can see this purple line, and then you can see this green line. Okay, so basically the green line is how your P&L will look like at expiration. But the purple line is how it will look like at the moment where you place the trade on. So at the moment when you place the trade on, if the market goes down, yes, you're going to see some loss, right? Basically because theta hasn't kicked in. You haven't given time for your option trade, this put broken wing butterfly, to really nurture the profit. Over time, you will see this purple line slowly go up here to fit to this green line down here. At the same time, on the other side, this purple line will go down to the green line down here, which also means that you will tend to lose more closer to the expiration if the market really goes down all the way past this break-even point. So that is why, if you want to be safe, you want to try and construct your tent somewhere just past this. Do you see this line down here, this gray line? This gray line down here is what you call the 1 standard deviation line, which is where there's a larger probability that the market will stay within this range most of the time, right? Roughly about 68% of time. Around there, that is where the market will be, and that is why this is how you can choose to construct where your tent is. If you're slightly more conservative, your tent, you can construct it more outside here. If you're slightly more aggressive, then you can put your tent somewhere inside this zone down here. Again, you can see it's very versatile. It's up to you to decide. All right, so why do we want to do this on the cash settled index options? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So by the way, there are quite a few cash settled index options. These are the main ones. This is the MRUT, which is the mini RUT index options. XSP is the mini SPX options. Then you have the SPX for the full size one, and the RUT. So if you have a pretty big size account, multiple 6 figures, then you'll be going for the SPX and the RUT. If you have a much smaller account, then you might want to go for this two first until you've gained more confidence, you've got more capital, then you go for the bigger size ones. So why only the cash settled index option? So the very first reason is because, remember, we want to design a passive income strategy. So passive income just means you want to do the work once, leave it, and then you wait for the income to come, right? So no point for you to put the strategy on and then you always have to monitor it every single day, adjust it. Leave that for the other option strategies. If you want something that is very passive, this is, I believe, the most passive that you can get, right? You just put it on once, leave it to expiration, see whether it's a profit or a loss. And most of the time, it's going to be a profit because this has a very high win rate. Now, next, it takes advantage of the positive drift. So I've mentioned this in quite a number of my videos as well. So what is the positive drift? Well, the positive drift is basically that the market wants to go up over time, right? Especially we are putting this on the index, which is just a basket of stocks. As you can see, the spiders, the IWM, all these index ETFs, right? Or index in general, basically go up over the long term. If you look at the price like 20 years ago, 30 years ago, you notice that the price is so much lower. So when you use the put broker wing butterfly, you're actually taking advantage of the fact that the market wants to go up, and because there's no risk to the upside, you're pretty safe there, right? Once in a while, there's going to be a crash, which can actually be good for your put broker wing butterfly because you can design it so whereby, when the crash comes, this is where your tent is. This is where your, max profit zone is going to be. Okay, so it takes advantage of the positive drift. Now, next is that it takes advantage of the put skew. So what is the put skew? So I've also mentioned this quite a number of times, but basically the put skew is that where, you have a skewer and you put your put options on a skewer, right? You have a put option here, more put options here, even more put options here. You put it on a skewer, you get a put skew. I'm kidding, guys. This is not a put skew. The put skew is whereby the lower strikes have a higher implied volatility. Basically, what it means is that you're going to get a higher premium as the strike goes down, which is very good for our put broker wing butterfly. Because what you will notice is that when you construct the put broker wing butterfly compared to the call broker wing butterfly, basically call broker wing butterfly will be on the upside. So it will be on the opposite side of the put broker wing butterfly. You will notice that your tent, all right, let me just bring back to this P&L down here. So you'll notice that your tent is going to be much smaller for the call side. So the call spread side will look the opposite of this, right? So basically the call side will be like this, okay? So this is where your P&L graph will be. So this is normally where the market price will be, all right? So what it's trying to take advantage of is if the market goes up, you try to capture it in this tent. But the problem with this is that because of the put skew, you can't get as big of a tent as the put side. Right, so maybe for the put side, if you were to use the exact same deltas, maybe this could be a max of maybe, let's say, $1,000. All right, let's just say $1,000. If you were to do the same delta on the call side, chances are that you're going to get much lesser, right? So maybe as an example, it's probably only going to be 500, and your zone, your profit zone, is going to be smaller as well compared to the put broker wing butterfly. So that is why we don't generally use the call broker wing butterfly on this index options. Now next, there is no early assignment. Now this is very important because you do not want to put on a position, and if it's in the money, somehow you're going to get assigned where you're going to be long some shares, short some shares, and that's going to destroy all your trading efforts, right? Because you're going to get so confused and you're going to worry about a margin call. So because the index options, they are operating on the European style, which only means that there can only be assignment or exercise upon expiration. All right, so the European style is much more tame compared to the ones that you're normally used to, which is called the American style, right? The American styles are the ones where you find on all your equity options, in fact, also on your index ETFs as well. So the American style options, you can exercise at any time. So if you're in the money, you might find sometimes, right, that you could be assigned early on it, and that's where the trouble comes. So the American style is slightly much more wild compared to the European style, right? The American style is almost like a Gangnam style. And also there is no assignment of shares, right? So it's very linked to this, but because this is the index option, this is cash settled, you will only be realizing either a profit or a loss in terms of your money. So it will either be, you will see a profit into your account or a loss from your account. Now, this is a very frequent question that I get whenever I share about any option strategies on my channel, is that, Davis, can we do this on the weekly options, or can we do this the 0 DTE options? I like to make money every single day. I want to see money into my account every single day. I like it wild. I like the Gangnam style. Well, the answer is technically yes, you can put it on, right, on the 0TTE, the weekly options, whatever, rocks your boat. Well, because the exchange actually doesn't restrict you from choosing which DTE you want to place the strategy on. So if you ask me, can you do this? Yes, you can do it on any time frame which you want. But the more important question to ask is there a statistical edge? Well, I'm going to show you this and you tell me, right? So first of all, our statistical edge is whereby the IV is greater than the RV, which means to say most of the time, the implied volatility, or rather this range down here, this one standard deviation range, the market actually tends to be, staying within here most of the time. That is how we are able to, make money from the expected move, especially we are trading this type of short option strategies where we want the market to stay in a certain range. So especially if you have this broken wing butterfly down here, you can see we do want it to stay inside this range more often than not, right? That's how we're going to profit on this strategy. Now, if you were to take a look at this table down here, so you can see this is a very significant data set. This has been done since 1993. So this is a comparison where it takes the expected range versus the realized move. So basically, it's the expected is the IV depicted by the IV, the RV, right? Realized move depicted by the RV. So as you can see, anything that is below 45 days, right, from 7 days all the way to 30 days, you can see that the RV, the expected move, is actually not bigger than the realized move, right? You can see expected bigger than realized, no. Only where the 45 days is, the expected move is bigger than the realized move. You can see that, which means to say this IV down here, this bigger one, is always bigger than where the market is actually going to go. And that's what we want when we put on this short option strategies. So you can see as well, right? If it's 45 days, it's yes, right? Expected move is bigger. 60 days is bigger, 90 days is bigger. So you tell me, right? You want to put it on the 7 days. Is it going to have some sort of a statistical edge? Right? This is something you may want to find out of yourself, but I lean on the data. So that is why I tend to go more for the longer term ones. So anywhere from 45 to 65, okay? Now, let's talk about risks. So risk is something very important because we always look at how much money we can make. Most of the time, that's what we are tuned to, our eyes, our mind. We just want to see how much we make. But many times we forget that there are risks in the trade. So are there risks in the put broken wing butterfly? And the answer is of course yes. So as you can see down here, your house down here, this tent is on a cliff, right? You can see this is the cliff. So if your tenants, let's say if they come in down here, they stay in the house, make sure that they always stay in the house or just play in the front yard. But tell them not to open the back door down here past this red door down here. Put the door in red so they know that they should not exit there, because if they do, man, they're going to be in for a very nice ride. And by that, I mean you are going to be in for a world of pain because you're going to start to lose money. So you need to understand that there are risks in this strategy as well. So as with many passive income strategies, there's always risk, right? Even rental income, right? You have risk when you want to find the property, you want to find the tenant, you do up, the place. There's all costs involved. And I can tell you it's a hassle because I've experienced in that area. I've rented a property and I'm telling you, it's not as fun as what the books or what people tell you it is. And I can tell you options trade is so much easier. Just put on the trade. You don't have to worry about too many things, right? Compared to rental income, or even in dividend stocks, right? Dividend stock, there's also the risk whereby you put into the dividend company, right? You buy the company and the stock can just plunge overnight, right? Some adverse news that's going to cause it to crash. So there's always risk. So for the put broken wing butterfly, it's the same as well, but there are ways to reduce the risk. All right. So similarly with option strategies, there's always risk. So although this strategy has a very high win rate, as you can see down here, it's also very important to exercise proper risk management. So proper risk management just means you want to have proper capital allocation. Make sure you allocate no more than 5% to 7% or max 10%, right? If you think that you're not going to have that many trades, right? If you're not going to have many trades, you're the kind where you like to put on a bigger portion of your account and hold on to the trade until it works out or not, then you put on the next trade. Yep, you can allocate up to maybe 10%, but I would say that's the max you would go. best stick somewhere between 5 to 7%. And you also want to have proper position sizing, right? You do not want to see what kind of credit you get down here and then base your sizing based on the credit. So let's say, for example, if you get $100 for every put broken wing butterfly you put on, you don't want to say, all right, I want to make $1,000 for this trade, so you're going to put on 10 broken wing butterfly. No, that's not what you want, because you need to understand that if you're going to have 10 times the credit down here, you're going to have 10 times the risk down here as well. So very important for you to understand. And last but not least, put broken wing butterfly, as we already know, the risk is on the downside. Anything to the upside, no risk whatsoever. Downside, this is where we will start to lose some money. So one way to circumvent this risk, to reduce this risk even further, is to shift this short strike down, right? The more you shift the short strikes further out of the money, then this is going to lower your risk and lower the chance that the market can actually get past your break-even point. All right, guys, so this is the put broken wing butterfly. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. All right, I will see you in the next video.